Can you guys hear me?
Good evening, Professor. Yeah, we can.
Yeah, please speak
Good
up.
evening, Professor.
Hey, good evening. I can barely hear you. Please speak up. Um, so many people are online today. Huh? So many people are online. Um, okay. So, uh, let's see. I would like to show you one thing because some people, this class doesn't have that much issue, but um, sessions, previous sessions. There's a way I can, good evening. There's a way I can also check how long people have stayed logged on. For example, I want to do, but I don't do this very often because it's not in alphabetical order. So for example, 25th, which was this Monday, these are the people who were online, and see how much total time they were online there. 14 minutes, 1 hour, 2 minutes, 22 minutes only.
No, I was on 22 minutes because I saw that everybody was
Yeah,
off
yeah,
and you
yeah.
didn't come on.
Yeah. It was partly my fault because I forgot to turn on this.
Oh, okay.
Because, by default, I'm speaking to the people in the classroom, and then I forgot, that I had to turn on. I didn't, but anyway, so if Tanvir Hassan, just 3 seconds, that cannot be accepted as attendance. But again, I don't do this. I don't check this very often because it's not in alphabetical order. It becomes very difficult if I follow this. It's not in alphabetical order, and the roster is in alphabetical order of your last names.
Mm-hmm.
So it becomes very difficult. It gets difficult to match everything. So unless I have a strong, grounds for suspicion that some people are not really logged in, not really doing anything, I don't necessarily go over this. Yeah.
Like, for example, I know there were some times that I was online, but it didn't record in the discussion board, and I know that's what you look at. So, for example, like when I emailed you, you would look at this to make sure that I was logged on. Okay. That makes sense.
I do double check, right?
Okay. I think I'm gonna be like the first thing in this because my last name is
Hello,
B.
Professor. I'm here.
I said, this is not in alphabetical order, first of all, and then not in the last name, right? So it makes it, it's a nuisance, really. It's very annoying to check this, but, sometimes I gotta do that. But I don't do that all the times. Yeah, Jasmine, you had a question, Jasmine?
Oh yeah. I know it says I joined for like 3 seconds, but I was in person that day. I just joined just to see something.
I can barely hear you. You need to speak up.
Speak louder? Okay. So I know it says that I was there, like I joined the Collaborate for like 3 seconds, but I was saying that I was in person that day. I just joined the Collaborate to see something. Can
Can
you
you
hear me?
guys hear that?
She said something about 3 seconds. When you remember the person that you pointed to, she said, it said that it was 3 seconds, but I couldn't.
Oh, that was her
Yeah.
record? No, 3 seconds, that was Tanvir.
Yeah, I was in person. I attended in person on Monday.
Hmm? Tanvir, are you the one speaking now?
No,
Yeah,
it's Jasmine.
Tanvir, but according to this, you were just logged in for 3 seconds.
Yeah, I attended in person on
Oh,
Monday.
it's 21 seconds, my bad.
So, look, this is This is a gentleman's agreement. I mean, obviously, you're not doing this for me. You're doing this for yourselves, right? So if you are not fully participating in class, then that, you're doing yourself a disservice, basically. Not, so I would expect you to be, fully, responsible for your own actions. Alrighty, so so the last thing we were talking about was, and where was that? Cost of K. Yeah. So I said we were going to do the last example, the final example, the mother of all examples, right? But before we do that, let's think about investment opportunity schedule. Investment opportunity schedule. Now, investment opportunity schedule is something that you have seen before, right? This is investment opportunity schedule. Remember this from the net present value, right? Capital budgeting. This was it was under the topic of capital rationing. Capital rationing. For example, there is. I can use this. I can use this. So remember in net present value, right? Cost of capital was just, we didn't have to worry about, we didn't need to worry about marginal cost of capital. We just had one, cost of capital, right? And then the question was, if our budget was this was our budget, which one fits our budget, right? Which projects? Projects with the internal rate of return, projects of generally ROI, return on investment, or did they call it? They called it internal rate of return of A. This is internal rate of return of B. This is internal rate of return of C, right? This level, this level, this level. Now, project A, B, and C all met the cost of capital, right? They are above cost of capital. So, and they all fit our budget of 5 million. So then project A, B, and C are all accepted, right? Remember? That was, what you saw previously in the in that, why isn't it? Okay. Now we have changing cost of capital, because cost of capital we are talking about here is weighted average cost of capital, and weighted average cost of capital can, make or break, right? Because when we start using more expensive capital, in this case, stocks. I mean, remember, up to $5 million, we didn't have to sell new stocks. We could fund the project with debt and preferred stock and the retained earnings. But once we start selling new stocks to fund the project. So then weighted average cost of capital makes a jump, right? It breaks. So it makes a break, right? So combining this investment opportunity schedule with the marginal cost of capital, that gives us a better view of which projects to accept and which project to reject. So in this example, project A, B, and C should be undertaken because their expected returns exceed the expected cost. Yeah, the cost, cost is, basically, weighted average cost of capital. So project A, B fit into this, you can tell, it can be accommodated while still our cost of weighted average cost of capital is 9.2%. But project C is still doable, right? And its internal rate of return is greater than 10.4%. It can, and total capital needed will be something like 7 million, I guess. It looks like this is somewhere around 7 million. And project C can still be accommodated because its internal rate of return is greater than 10.4% weighted average cost of capital. Okay, so that's basically combining investment opportunity schedule and the marginal cost of capital. Okay, now finally, the comprehensive example, Baxter Metalworks. Baxter Metalworks has the following capital elements. Of course, debt. Why? It's got debt, preferred stock, common stock, right? That's very usual. So Baxter issued 30-year bonds 10 years ago. So that means time left to maturity is 20 years, right? Time to maturity, 20 years left. At the coupon rate of 9%, coupon rate, right? $5,000 bonds were sold at par. Oh, it was sold at par. So at the time, so in other words, 10 years ago, at the time of the issue, the discount rate or yield to maturity was also 9%. But now the yield to maturity or discount rate is 12%. So obviously now it will be a discount bond. I mean, meaning, the bond will sell below par value now, right? Now, preferred stock, 20,000 shares of 10% preferred stock were sold 5 years ago at $100 par value. So 10%, that's the dividend, right? So that means, because par value was $100, that means dividend is $10. Currently, it yields 13%. For it to yield 13%, obviously the price should be lower than $100. If the price is $100, then it would be 10%. the price is something like, 80 something or whatever, then it's more, the yield would be like 13%. So based on this, we can all calculate the market value of the debt, preferred stock, equity, and then equity. Company originally financed with the sale of 1 million shares of common stock at $10. Accumulated retained earnings are currently 3 million. Okay, so look, we cannot, we don't have to sell new stocks. We don't have to sell new stocks. Up to 3 million, we can fund it by retained earnings. But depending on, how much capital is needed, if we might need to sell new stocks. But let's see. Currently, the stock is now selling at 12.5. So we know the market value of the common stock. The market value of the equity is, 1250 times 1 million, right? 1 million shares. This is the easiest one. Market capitalization, right? This is the easiest one. Capitalization. Well, that means market value, market capitalization. Market capitalization, that means market value. So first, our target capital structure is 20%, 10%, 70%. And Baxter's marginal tax rate is 40%. In other words, why do we need marginal tax rate? Because when we calculate the cost of debt, we need to make adjustment for that tax shield effect. Flotation cost, 10%, short-term T-bill. So why do we need short-term T-bill rate and average stock market yield, beta? This is for finding cost of equity, right? Of course, this is for cost of preferred stock. This is for cost of debt. Of course, cost of debt must be adjusted, right, by this. Flotation cost, you need to make adjustment for flotation cost. If you're selling, preferred stock. So these are basically the input data we need to find the cost of, capital. And all of these. And the expected profit, or EAT, 2 million, of which 1.4 million will be retained earnings, right? Okay. Accumulated retained earnings are 3 million. So currently, we already have accumulated retained earnings of 3 million, and next year, we're going to have 1.4 million added to the retained earnings, right? So capital components, So capital component weights and weighted average cost of capital before and after the retained earnings break. So two-part question, component, we need to find the weight before and after the break. Before and after the break means, think about it. Using retained earnings only, and if we can use only retained earnings, that preferred stock and retained earnings, then there will be no need for the marginal MCC break, right? Marginal cost of capital break. But if we sell, so before and after, if we sell, this is actually not retained earnings break, but MCC break. But if we have to sell new stocks, then definitely our weighted average cost of capital will be higher. So before and after that break. Sketched up firms MCC do this thing, right? What they are saying is do this thing, draw this, okay? So now it's all verbally explained here. I would say, you might say that's not verbally, but to me it's verbally. So I'll show you what I did in Excel. That may look so. Okay, let's do this. Let me make it a little bigger. All right. Maybe I could probably rearrange this to be better, but when I made this, when I built this, this was what came to my mind. So first, we'll have to first find the market value, right? Book value, it's obvious. There were 5,000 bonds sold, right? Issued and sold, and par value is 1,000. So book value is, it's just, supposed to be like that. Preferred stock, the par value of $100, and 20,000 was sold. So simply that. Equity, when they were sold, it was $10, right? First issued, right? IPO price was $10, and 1 million were sold. So 10 million, that's book value only. Now, total would be like this. So sum, but that's only the book value. And the retained earnings so far, retained earnings, 0 means what? Accumulated retained earnings, until time 0, there has been accumulated retained earnings of 3 million. But there will be, at the end of the year, right? Retained earnings expected at the end of the year, 1.4 million. That was given already in the scenario, right? So now let's find the market value of these. And to find the market value, right? First of all, we need to find the price of the bond. And the price of the bond times, not the par value, but the market price of the bond. So the market price of the bond, we know the bond valuation formula, right? If you don't remember, I'm gonna write it. I'm gonna write it to the side later. But okay, let me write it to the side. You should. Okay, here. It's best to put it here. So, where is, okay, draw. Oh, too thick. All right. So you all know that bond price is coupon payment over R minus coupon payment over R times 1 plus R raised to N. That's only the annuity part, right? Oops, why I didn't want to move anything. Only the annuity part. And then the face value must be discounted to present, right? So we'll do exactly that. Coupon payment is annually 9%, but that should be divided by 2, right? Because bond is on semi-annual cycle, so every 6 months, right? So you have to divide it by 2. And then the cost of debt is that, and then also divided by 2. Then let me just copy this. It's getting very tedious. Payment over R times, so this is, I'm doing this part, R times 1 plus R. Now you should remember why we are dividing by 2, because what is given here is all annual, right? Annual rates. But you understand bond is on a semi-annual cycle, so the periodic rate, it must be divided by 2, right? The annual rate must be divided by 2. And then the whole thing raised, this thing raised to how many years left? 20 years. Was it 20 years? So if it is 20 years, then 40 semesters, right? 40 semesters. Okay. And then, where is the, of course, now this part, raised to M3 times 2. 20 years times 2, 40 semesters, right? So hit enter. Now, Yeah, that should be, that sounds quite, that should be very plausible because you have, think about it. You have a bond that pays only 9% while the prevailing market rate is 12%. And I told you this is going to be a discount bond, right? Because it's paying lower interest than the prevailing market rate. So that's why, and this is exactly, it proves that point. So the market value will have to be 1,000, how many? 500, or 5,000, 5,000 bonds times market price. Okay, there you go. This is the market value of the bond. And then preferred stock. It's paying 10% dividend, but the discount rate is currently, the yield is 13%. That means the discount rate is this. There you go. The price, then think about it. $10 on $77 would be like 13%. So we got that. Market value, I'll just drag it down. That should be, right, the market value of these 20,000 shares of preferred stock. Now, we don't need to do any further because there is 1 million shares of common stock, and its market price is currently 12.50. So we got that. And the by auto sum, right? That's the total value of our capital. Total value of our capital. Okay. So the weight is now, we can find the weight. So I'll use something like, okay, this would be a good color. The weight is now this divided by the total, and I'm gonna lock the denominator so I can copy and drag everything. Okay, so this is the weight, 21.6% debt, 8.6% preferred stock, 69.8% equity. And let's check if that's what they got in the 21.6 preferred stock, 8.6 equity, 69.8%. That's what we got, right? And of course, if you do auto sum, then we'll get, the sum of all of that must be 1. Now next, then so progress check. Everyone got the same result? I guess. Okay. I guess the rest of it is not that difficult. I think this one took some time, I believe. This one could have taken some time. Okay. But keep in mind, this is exactly this formula, right? But making adjustment was a little, what should I say? Pain in the ass, right? Pain in the neck, because you have to remember this is annual coupon payment, but since bond is on a semi-annual cycle, you have to divide it by 2. Everything right? Even the discount rate, everything has to be divided by 2. And then for n, for this n, it has to be multiplied by 2 because, if 20 years are left, it means 40 specimens, right? And since bond is on semi-annual cycle, that adjustment has to be made. So if you keep that in mind, then maybe this one was the most, unknowing part, but it's just mechanical. And you just stay, if you stay focused, making adjustment will be a easy thing. Now, and then this is just, perpetuity formula because preferred stock is a perpetuity. And in perpetuity, the formula for perpetuity is, where? Dividend over R, the required return. The required return is the cost of equity, of course. And I'm talking about the preferred stock. Preferred stock is perpetuity. So this is the formula for preferred stock. And, so that's exactly what is there, right? And once that is done, and then market value is basically, price times quantity, price times quantity, price times quantity, right? There you go. And auto sum, right? And then we can find weight, finally, based on the market value, right? Then you drag it down. So if you got it right, now let's get to the pre-break adjusted cost of capital and pre-break, post-break adjusted cost of capital. First, this is target capital structure, right? But currently, the capital structure is currently like this. So we need to, you see, we need to reduce debt slightly, and then we need to increase the preferred stock slightly, and then also increase the common stock slightly, right? If you want to reach the target capital structure, right? So we're gonna have to do something. But as far as the debt is concerned, we don't need to sell new debt, right? We don't need to sell new debt. Actually, we'll have to buy back, right? And reduce the, and then reduce the debt, right? Component. And then preferred stock and common stock will need to sell new. I mean, preferred stock will need to sell new. But let's see if we need to sell common stock or not. Because retained earnings alone may be able to do that, right? And if the retained earnings can do that, then there will be no break in the marginal cost of capital. But anyway, first, pre-break adjusted, we already know what to do. It's basically cost of debt times 1 minus tax rate. And the tax rate is here. Down here, I have organized all those things that were you see in the slide, it was thrown in like this. Marginal tax rate, flotation cost, okay? Those things I organized it, all, summarized and organized it in here. Now, So if we adjust that for, if we adjust this for flotation cost, then 1 minus, where's the flotation cost? Flotation cost, 1%. All right. And then I think this risk premium, okay. So I'm gonna rearrange this a little. I'm gonna do, I think it's better to use Gordon here. Let me see, and 4%. That was risk premium. You guys remember that there are three ways to find cost of equity. One is by CAPM, second one by Gordon growth model, third risk premium. Okay, so I don't remember if they gave risk premium here, but generally it is 3 to 5%. You add 3 to 5% on cost of debt, right? So that 4% was the middle of the road. 4% was middle of the road, and it didn't specify in the example. It didn't specify where the 4% came from, but conventionally, so I'm going to have to conventionally, you add 3 to 5% risk premium to the cost of debt to find cost of equity, right? That's the risk premium method. And if the company is considered relatively not very risky, relatively safe, then you just add 3% risk premium to cost of debt. If it's considered risky, 5%, you add 5%. But it's just rule of thumb. That's why I don't like risk premium method, because it's just rule of thumb. And the middle of the road is 4%. So in the previous example, they used middle of the road, so they used 4%. So I put 4% there, but no need to rely on risk premium method. I just so I put Gordon on top. So let me clean up the borderline. Thick outside. Okay. Now, so if we use Gordon growth model, remember we did this a lot. We'll just don't want to do this again. But you see, this is how you find the cost of equity using the Gordon growth model. But this is even after adjusting for flotation cost. So if it was without the flotation cost, then it's just like this. Okay. So if you are going to use retained earnings, then this, right? But if you are selling new stocks, then it has to be like this. Okay. So using this formula, right? So what goes in there? Gordon model, right? Cost of equity. Come on. Cost of equity using Gordon model. Dividend at time 1, which is dividend at time 0 times 1 plus growth rate, over P0 plus growth rate. So I'll plug it in here. So, oops. I should stop inking. So dividend was what? $1.10. That was the dividend at the end of last year, or the beginning of, and then beginning of this year, plus, and times 1 plus growth rate, 6.5, and we divide it by price of the stock at time, price of the stock at time 0 is this, plus growth rate. Okay, by Gordon model, the cost of that is, I'm sorry, that's adjusted. So before it, not adjusted. We're gonna use that. We're gonna keep that. Okay. So again, dividend times 1 plus growth rate divided by price plus growth rate. Okay. Give it percentage. Give it 2 decimals. And then this one is adjusted. Pre-break adjusted. Okay. So all I need to do is simply, divide this by, okay, 1 minus flotation cost. Okay, after adjusting for flotation cost, right? Double check. Yeah. Oh, what did I do? We're dividing it. We're dividing it. The whole thing is, so, yeah, dividing it. So. And then, if we use CAPM, CAPM is what? The risk-free return plus 1 minus risk-free return plus market return minus risk-free return times beta. Okay, so, and why so many decimals? Okay, that's good enough. Now, everyone, even if I don't write this down, you should, CAPM, you should understand. You should have it in your mind already. Basically, cost of using, why is it moving? Okay, now it should. Cost of equity using by CAPM is risk-free return plus market return minus risk-free return, risk-free. So did I use, that notation is so, okay, I'll just call it free, risk-free times beta. And this is what? This is what went in there, okay?
That's times beta, or you said plus beta?
Times beta,
Times beta.
times beta, okay? And again, risk premium method is already, there is nothing mathematical. You just add 3%, anywhere between 3 to 5% to the cost of debt, right? And they used, they used middle of the road 4% risk premium. So then this thing should be simply so. Oh yeah. Why is it still doing this? We'll simply add to this. We'll just add 4%. Now, for this, oops. After making adjustment, right? Okay. Did they do this? All right. Let's not bother. So after making adjustment, then of course, then is adjustment for flotation cost. So all you need to do is just 1 minus flotation cost. And there you go. That should be the CAPM, right? For after adjusting for the flotation cost. But again, think about it. We may not be using this before the break in the marginal MCC, right? Before MCC, right, break, there's no, because we're not selling, think about it, before MCC, we're not selling this. We're not selling new stock, right? We're not selling new stock. Actually, this should be something here, used here. There should be something used here as well. And this should be here. So the thing is, of these, think about it, of these three, we have cost of equity by Gordon model is this, cost of equity by CAPM is this, then cost of equity using risk premium is this, and between these three numbers, which one would you use? Well, you can use this or you can use this, but I would use the middle of the road, right? They are not very extremely different, but between the two extremes, I would use the middle one, right? So eventually, for cost of equity, we'll do that. And then if I adjust this also for, after break, if I use flotation cost, adjusting for flotation cost, right? It would be like this. Now, the next question is then, what is the weighted average cost of capital? And that would be 9. What is the, where does the marginal cost of capital jump happen? Where does it happen, right? It looks like 2 rows, but it's actually 1 row. Then weighted average cost of capital is then what? Literally, we know weight, right? Weight times this plus weight times this plus weight times this. Okay? Right? Everyone is okay with that? Because I'll hit enter first. Weighted average cost of capital by definition weight of debt times cost of debt plus weight of preferred stock times cost of preferred stock plus weight of equity times cost of equity. So that's what I did here. 13.96. Is that what they got in the slide? No, it didn't give me any. Yeah, here. Pre-break, 13.9, right? You see that? 13.97. So that's what we got, right? So weight, cost of capital, right? So this times this, this times this, this times this, right? And then if you do add them up, 13.97, but that's rounded already. What I got is 13.96. Okay, that's pretty much the same thing. And then where does the jump happen? So basically, what this is telling you is if we use, next thing, if we start selling, right? If we start selling new stocks, the cost of equity will be this, and that's what we found. I believe that's what we found. And then weight times this weight. This weight times this will be this. And then we come to 14.6. So let's see. After the break, I got 17. After the break. This one. something, yeah, using Gordon model. If we use Gordon model, so I don't know why in the example they didn't consider the other things, but they used only Gordon model there. So pre-break or post-break, basically, adjusted cost of debt, adjusted cost of preferred stock are the same. The adjusted Gordon, by Gordon model, we got this. So basically, if we do the same, again, I'm going to use, because I'm going to show you something. Some product is a way of basically multiplying this row, that column by this column. What's going on? D3, D5. Oh, comma. We're multiplying this column by this column, right? So if I do it like that, I don't have to write it all over. So this is basically, this is weighted average cost of capital after the break, right? After the, in other words, when we sell new stocks. And then, so where does that happen? In dollars, right? So basically, break in the MCC will happen at this point because what was that 3? Okay. What is this? Do you remember what this is? This is the retained earnings at time 1. I mean, we're going to have this retained earnings, right? And that would be 69% of the capital needed. I mean, we are raising new capital by that the weight in the weight of the capital components. So this is 69.8% of the total capital to be raised. So if you solve it for that, so this is the total capital, and this, in other words, this times 69.8% is 1.4 million. Okay. Right? So solving for K, then you would have to divide this by 69.8%, and we come to this. That's what, so something we can do here. We divide this by this, and we get 2,005,919, which is, yeah, slight difference because, they are using a lot of, rounding, but, this is straight from There's no rounding here. So we finally got this. So this is where, the MCC jump happens. Okay, so, wow, it's 7:10, so we finally covered this. I know at this point, it may seem quite scattered and, confusing, but you should stay focused. I mean, if you go over this again, and read what the example was asking for, you will get it. Basically, the problem was asking for the components weight, right? And weighted average cost of capital before and after the break. And the sketch the firm's MCC. To sketch the firm's MCC, you need to know where the break happens. So the break happens, weighted average cost of capital was like, 13.9 something. But, beyond 2,005,000, the weighted average cost of capital, or marginal cost of capital, jumps to 14.6% because you have to sell new shares, new common stock. Okay, so that concludes this example. All right. I know you don't have any questions because to ask questions, you should fully comprehend this. But go over this. I always post the recording of the session, so go over this. And also read the verbiage in the example. So then you'll get it. All right. So our time is up. So let's. I'm gonna save this. So let me say goodbye to the people in the. Where are these people? All righty, guys. If you have questions about this, please email me or use my office hour. Okay. All righty. So
Thank you,
stop
Professor.
recording.